Welcome to our maiden voyage here of the Monday show. I'm Woodall, Mike Rarey. So this is the first of our live shows we're putting out in an effort to better connect with clients and talk about what's happening in the markets, take questions, discuss portfolio positioning, and really just allow you more transparency into the day-to-day things we do. This is an unscripted show. We have a general outline of what we're going to be focusing on. But really, this is an opportunity for us to share with you the things we do week to week, day to day, and ask questions and look a little bit deeper into our process. Welcome, Mike.
Yeah, thanks for having me.
We're pretty excited about this. I mean, we think it's important to sort of give you context of the things we look at on a regular basis in putting together our portfolio positioning and our outlook. And so we're going to throw up our framework. So again, our investment framework is based on inflation, growth, money supply, and recessions. So we're going to throw up the first discussion point, which is inflation, which here we go. All right, so we've talked about this chart quite a bit, the path of inflation. And tell the viewers what this means to us in terms of how we think about inflation impacting the way we invest our clients' money.
Yeah. So like each of the factors in our framework, what's important to note is inflation, is economic growth, is liquidity high or low, and is it rising or falling? And based on that, that creates four regimes. So low and rising, high and falling, low and falling. And different asset classes perform differently in each of those regimes. Right. So if we narrow that down to inflation, we have been in a high and rising inflationary environment. And that is the worst environment historically for fixed income asset classes. Right. When that happens, that puts upward pressure on inflation expectations, which represent a good portion of bond yields. And so bond yields go higher, means bond prices go down. Once we shift from high and rising inflation to high and falling inflation, we do a 180 basically. We go from the worst environment for fixed income historically to the best environment for fixed income historically. So this is absolutely critical, being able to look 12 months out and say what's going to be the path of inflation. And we have very high confidence, regime confidence, that we are on the cusp of shifting into a high and falling inflationary environment. Yeah,
I mean, for sure, we know we're high. I mean, just look back historically, we've never been to that point since well before the 90s. Yep. And the falling part, as you said, really does make the setup for fixed income much more attractive, right, going forward. And if you look back at these points, any points where we were low and rising or high and falling, it proves itself out. I think that favoring fixed income potentially over equities is a better trade-off for us.
Yes.
So talk about that context of inflation in terms of time frames. So falling, how this is a pretty dramatic fall we're projecting here.
Yeah. So these are the year-over-year numbers, right? So there are tremendous base effects, and what can happen is month-over-month inflation prints can be zero. They could even be negative, but that year-over-year number can still be elevated. So what you see is not only what's getting tacked on at the front end of this year-over-year number, which is lower and lower inflation numbers, but then also what's getting taken off of the back end. Both of those things can bring down the year-over-year number. And if we were to talk about that light blue shaded area, why we see inflation coming down this magnitude, the first couple months that get tacked on the year-over-year numbers, those come from inflation nowcasts, which right now are saying that the July print for headline CPI should come in right around 8.8, and then the August print should be even lower than that. Right. So starting to confirm over the next couple months because of that, the downturn in energy prices recently, that headline CPI should start rolling over.
Right. I think what that implies and what we're actually seeing in fixed income market is rates peaking. We've actually seen rates come down from what we think were the highs earlier back in June.
Exactly. Yep. Yeah, the high in bond yields usually coincides with the high in the year-over-year inflation rate.
Yeah.
So they start coming down.
So for clients to understand how inflation impacts bond rates and what the Fed does, the Fed's still raising rates, but they're raising the very short end of the curve. The longer end of the curve is telling us we've probably peaked out for the year.
Right. Yep.
Okay. Let's look at liquidity. So another big factor in our framework is liquidity. And what liquidity means to us, it almost looks like the last chart, right?
Right.
But there's so much more to liquidity than meets the eye here. And there's a lot of nuances to liquidity. So talk about what liquidity means in our investment process.
Yeah, liquidity is the growth rate of the money supply. And once again, is it high or low, rising or falling? And liquidity, when money is being created, it has to go somewhere.
Right.
So it's either going to manifest itself in higher financial asset prices, which usually happens, or stronger real economic growth, or higher prices of goods in the economy, inflation. It's going to manifest itself in one of those ways, right? And central banks around the world, it's their job to try to control inflation. And they do that by controlling the growth rate of the money supply.
Right.
So what we're seeing in this forecast horizon is central, in this instance, the Fed, because we're talking about the US. This is what it looks like when you raise interest rates as aggressively as they're expected to, reduce the size of their balance sheet, and then also there's no fiscal stimulus on the government side of things. You fall into a low and falling liquidity environment, which is the worst environment for equities.
Yeah, and I mean, and just for a viewer's standpoint, give context to this just unimaginable rise in liquidity.
Yeah. So post-COVID and during COVID, more money was created in a shorter period of time than any other period in history.
Right.
The most dramatic way to say it is over a third of all US dollars in existence today were created since March 2020. And that is exactly why when we had an unprecedented economic slowdown, basically shut the lights off in the entire economy, the US equity market recovered all of its losses in just a couple months.
Right.
Because money was created and it had to go somewhere. Well, the economy's closed, so I can't buy stuff, so I'm going to buy assets. Financial asset prices recover. And that's probably the clearest way to see the positive effect of liquidity. Right. And what we're heading into is sort of the exact opposite of that scenario, where now the economy is booming in nominal terms. It's booming. After you subtract inflation, not so much, but booming in nominal terms, but asset prices are selling off. Why? Because money is not being created. And so where is the next marginal buyer of financial assets going to come from if no money's being created?
Right. And so historically, money's created at about 5% year-over-year change, right? So we went up to 25% in that period. And so a question we often get, or I often get, is, well, this money's still out there. Why doesn't it justify these higher stock prices? And what would have to happen for the money supply to return to a normal trend?
Yeah. Well, if all of this money went into the economy and it did not create inflation somehow, then you're probably right. It would justify higher stock prices. But because a lot of this money, too much was created too fast for the amount of productive capacity in the economy, it went into inflation. And we all recently rediscovered how much everybody hates inflation. That means that central banks have to put the brakes on it.
Right.
And so they're making money more expensive. They're raising interest rates, reducing the size of their balance sheet. So, that's definitely a negative for equities. And then the other thing that's important is if the US economy is huge in real terms, right?
Yep.
Over $20 trillion. That's great. But if it doesn't grow over the next year, that's really bad. So what matters is the growth rate, not the levels. That's why we focus on the year-over-year change in money supply, so the first derivative of money supply, and then is it rising or falling? So the second derivative of money supply, because that's what markets care about.
Yep. And so as we look back on the bottom of that chart, we're entering a period we've never seen historically.
Right.
And it's foundational to our outlook for the next 12 months.
Mm-hmm.
What could drive this number back up?
Well, you'd have to see the opposite behavior of what central banks and governments are doing right now.
Mm-hmm.
You would have to see the Fed cutting rates, adding to their balance sheets. You would have to see the unemployment rate rise to the point where transfer payments are being dealt out by the government. You would have to see more fiscal stimulus. And once again, nobody wants their name attached to anything that is seen as contributing to inflation.
Mm-hmm.
So the probability of those things happening, very low.
Yeah.
Usually when the stock market is down this much and we have 2 negative quarters of real GDP growth, the Fed's not thinking about hiking rates.
Right.
They're already cutting.
Right.
And we are doing the opposite. Globally, we're doing the opposite.
Yeah. And so we'll get to the question that's probably on your minds is the Inflation Reduction Act and what that does. But we'll continue on here with a look at growth because that's the next dimension of our framework here. Mm-hmm. Economic growth. So you said 2 consecutive quarters of negative GDP growth. Talk about how we factor this into our investment outlook.
Yeah, we look at real GDP growth. So nominal growth, subtract out inflation, you get real growth. And we look at it year over year, which is different from what gets quoted in the news, which is the quarter over quarter annualized rate.
Right.
So, and once again, is it higher, low, rising, or falling? And what's important here is we're forecasting we're going to be low and we're going to be falling. And that is the worst economic growth environment historically, that regime for equities. Great thing for bonds. Bond yields usually come down, especially longer term bond yields usually come down. And then what's sort of, I guess you'd say maybe the third derivative that we don't show here is how much each of these light blue bars keep getting revised down.
Yeah.
They just keep coming down. And that's because the economic data just keeps falling short of expectations. Really the only piece of the economy that in real terms right now is surprising positively is the jobs market.
And explain why that is, because when you're faced with such strong money supply, now coming into a deceleration, but why is the job market so strong?
Yeah, that's a great question. Part of it is labor force participation rate is far lower than it was before. Mm-hmm. Part of it is everything that happened since COVID in terms of geographies and demographics and people exiting the labor force. There's a lot of that going on. Mm-hmm. And then the other part of it is, these negative quarters of economic growth. It's negative quarters of real GDP growth. Yeah. Okay. So in nominal terms, the U.S. economy is doing extremely well. Growing at 6-7% quarter over quarter, first 2 quarters of the year. Mm-hmm. Normally when we see the jobs market really soften, it's when nominal growth is flat to negative and real growth is flat to negative. Right. So,
okay. And then the obvious next step in this analysis is recessions, because recessions absolutely matter in terms of avoiding large drawdowns, which is one of the things we try to do for our clients is to minimize the impact of drawdowns and sidestep those big punches the market throws at us. So recessions matter. Mm-hmm. Our recession forecast model is something that we've been working on feverishly to really refine. So maybe take us through the current model we have and the probabilities and how we've been working to refine it.
Yep. So our current model focuses on 13 indicators. Some of them are market-based, so things like where's the S&P 500 relative to its 52-week high? Where's the VIX? Where are high-yield bond spreads? Some of them are longer-term leading economic indicators, things like heavy vehicle sales, WTI crude oil, what's the year-over-year change in that? And then there are also best-in-class recession indicators, like the SOM, the PIGER, the New York Fed, Cleveland Fed has theirs as well. And put all those things together, and they each give you a lead on a recession of a different duration. So some are good at confirming if we're in a recession or not right now. Labor market's really good at that. Some are really good at telling you if a recession is likely in 12 months, like the U.S. Treasury yield curve is really good at that. And some fall somewhere in between, things like new orders to inventory ratio, things like S&P 500 as a percentage of its 52-week high, those types of things. So we combine these indicators to forecast the probability of a recession in the next 12 months, 9 months, 6 months, 3 months, or right now. And as we sit here today, it says, you know, our indicator suggests there's about a 17% chance we're currently in recession. And over the next 12 months, there's about a 40% chance. And that, thankfully, has come down a little bit over the past month as we've had this bear market rally, because a lot of those market-based indicators have relaxed quite a bit. They were pretty stressed, and they've relaxed, and so the probability has come down. But we've already passed sort of the point of no return historically. So,
yeah, I think the important thing to note is, as you can see, the numbers are pretty volatile, especially recently. We've got a lot of signals here that are showing a lot of volatility. So as this evolves, it's not an exact science, but as it evolves, the volatility alone gives us a little more pause to make sure we are ahead of any potential recession.
Yeah, and one more bit of nuance, if we can, you know, we say recession forecast here. Now everybody appreciates, because we just had 2 negative quarters of GDP growth, that there isn't one universal definition for recession. You know, within our framework, we care about what matters for financial markets. So when we talk about a recession, we're not following a technical recession definition. We're not following the National Bureau of Economic Research definition. We're talking about a very specific regime in the economy and markets that is a self-perpetuating negative spiral of events. Sentiment gets worse, and then the hard economic data gets worse, and that causes asset prices to cascade downwards, and so on and so forth. We're trying to predict the probability of that market environment, which can be different and occur at a different time than 2 negative quarters of GDP growth.
Absolutely. All right, so let's take some questions. We got a couple questions here. First one is, what is a bear market rally, and how do you know when it's over?
Yeah, so a bear market rally is a trough to peak rally, equity market rally, that does not allow you to exit a bear market. So you think, what's a bear market? You go down 20% from your peak, all right? If you have a rally within that bear market that doesn't get you all the way back to where you were, then that's called a bear market rally. Bear market rallies feel real. Every actual rally that gets you out of a bear market starts as a bear market rally, right? And they are common characteristics of bear markets. So if you look at every single bear market since the 1920s, pretty much all of them have had a bear market rally of at least 7% that lasts for an average of 60 days. And this is why bear markets can be so punishing and so volatile and so emotional for people. Because it's really hard to know where the bottom is.
But there are some things to look for. So things we look at are volatility and volume on these rallies. So one of the characteristics of this bear market rally we're in now is it's generally the bigger move days are on lower volume and lower volatility. So as we see that, you can basically translate that into there's not a lot of conviction buying here. Until we start to see that, that's when we think you could break out of a bear market rally. But we're not seeing that. So one of the reasons we're selling into it versus participating in it. Next question. Let's see here. If you say that recession probability is rising, why is the labor market so strong? We kind of covered this, but if you have any other comments you want to make here.
So it's not uncommon for the labor market to be one of the last things to break when you go into a recession. Labor market indicators are very good short-term recession leading indicators, meaning they basically will just confirm if you're in a recession or one of the last things that happen is people start losing their jobs. So this is actually not unique at all. You typically don't see the job breakdown until you're already in the recession.
Mm-hmm. And there's no rule that says we have to have the labor market break down to be in recession. I think that's a big misnomer. We may do just fine with the labor market and still have a recession.
Yeah.
All right, I think we got one more question here. I'm going to throw it up so I don't have to read it here. Knew this, yeah. We said here today the Inflation Reduction Act was just passed. What is going to be the real impact on inflation, and how do you hear different versions of this depending on what channel you turn on to listen, but how will this be really influence day-to-day prices in the short term?
In the short term, not that much. So the CBO scored the bill, and from a budget perspective, but also in terms of impact on inflation, and basically came to the conclusion that it will have a negligible impact on inflation over the next 2 years. Mm-hmm. And if you think of what the bill is in big, broad strokes, you have roughly $700 billion of revenue increases, so increased taxes. Yeah. That will more than offset 300 some billion in spending on energy and climate type expenditures. Mm-hmm. No doubt the expenditure side is going to be inflationary for any item that is involved in anything that's built, whether it's a wind turbine or anything like that. Mm-hmm. So that part will be inflationary eventually when those expenditures happen. But raising extra tax money to pay down the deficit, if it happens, is disinflationary.
Yes.
Typically, that does not happen. If we're going to collect $700 billion in tax revenue and we're going to spend $300 billion on clean energy type investments, what happens with the $400 billion? Well, when the bill comes out, it's normally said that that's going to pay down the deficit. But in reality, a lot of that, the deficit does not get reduced by that much. It gets reappropriated somewhere else, so on and so forth. So bottom line is it shouldn't make a huge difference. It really shouldn't make a huge difference. This is more about climate goals by the end of the decade. Right. This inflation story that's playing out now is going to largely be unaffected by this bill.
We don't see people's energy bills coming down as a result of them passing this in the near term.
Right. I think it's more so the name of the bill speaks to how important it is to get a win on inflation, or a perceived win on inflation before midterms.
Right. And that's midterms are right around the corner.
Right.
So having that out there will definitely support votes. I think that was the last question we had. Do we have any others, Audra? Doesn't look like it. Awesome. So this great first show here, pretty exciting. We'll dive into more of our thought process and our investment process in future shows. But thanks for joining, and we'll see you every Monday here at the 1 o'clock hour.